risk exposure and hedging. So basically, once we've applied proper money management that we've seen in the last video, we know that we are risking a maximum of 2% per trade, all right, and probably less on every trade. And we've got everything about risk management with our drawdown levels, all right. Now, all this needs to be linked to correlation, okay? Why? It's because basically, so we want to risk, let's say, 1% per trade, but imagine all our trades move sort of the same way and we've got sort of the same position on all these pairs. Well, what happens if we lose one, we'll lose all the other ones. So instead of losing 1%, we're losing, let's say, 4%, okay? Because our 4 trades were really similar. So we need to basically see our risk exposure in the market, all right? So let's say, for example, Kiwi CAD, I'm short. And let's say I'll go on Kiwi dollar and I see a short opportunity, all right? Well, in both cases, I would short Kiwi, all right? So that means if Kiwi suddenly goes up, well, what happens is that I will get fucked probably in both trades, all right? Both trades. So how can you see the correlation? There's a few ways. First of all, you can click on this, which is compare. So let's compare Kiwi CAD against with Kiwi dollar, right? Bam. So let's put that a bit so we could see it properly. Okay, here we are. So what can we see? We see a downtrend on Kiwi CAD and a downtrend on Kiwi dollar. Then goes up. So this is Kiwi dollar, sorry. And the blue one is the dollar CAD, okay? And what we can see is basically reversal points are approximately the same, okay? And there we had this strong bearish move, which started here exactly like Kiwi dollar, all right? And now it's consolidating, all right? So we can look at correlation like this and see if pairs are moving the same way, okay? And we don't want to be too involved with one currency pair, obviously. So that's one way. Now, the next way is to basically know them. So we know that euro dollar and pound dollar often moves the same way. Why? Because there's a dollar in, okay? So the only time it will change is if there's some main news on pound, for example, and pound dollar crashes and euro dollar doesn't crash, okay? So that's basically the ones you need to know. And same for, like, for example, dollar Swiss and dollar yen, okay? Because the Swiss and the yen are both safe haven currencies. The dollar reacts approximately the same way, all right? So same here, we could go and look at dollar Swiss. We've got a trade running on that one as well that I showed you on one of the videos, okay? And now let's compare it to dollar yen. All right, what can we see? Exactly what I was saying, okay? That they move, see this, all right? This forms the sort of the same patterns, okay? So here, I'm already short the dollar Swiss, and I was looking to short dollar yen as well. So there I need to find the best pair, okay? So I allow myself to have 2 trades on the same currency pair, okay? So I could short dollar Swiss and short dollar yen, for example, if I've got nice setups. But I wouldn't do 3, so I wouldn't short dollar yen, short dollar Swiss, and short dollar CAD, for example, okay? Because my risk exposure is way too exposed to what the dollar is going to do, all right? So I'm not in full control anymore. So this is all about correlations. And then this is correlations in the sense that if you see euro dollar going down and dollar yen is also going down, that means euro yen is going down even more, okay? So you need to understand them. So why? Because euro dollar goes down, that means the euro is weaker than the dollar. If dollar yen goes down, that means the dollar is weaker than the yen, sorry. So euro is much weaker than the yen, all right? So this is why this pair will move a lot, okay? So good to know as well. And then the next way to know about correlation is by using matav.net. That's a website to show you at the beginning of the program. So in trading tools, all right, you find Forex correlation here. And here you can see all the correlation because, so basically like Let's look at 4 hours. Euro dollar and euro dollar, it's 100% correlation. That means it moves totally the same way. All right. What can we see here? Dollar Swiss and dollar yen, as we were saying, moves 95%, sort of the same. Okay. So you can look at correlation also on matab.net. Here, so yeah, important to remember not to be overexposed. So if you are already short on dollar Swiss and maybe another dollar pair, well, if you see a nice setup shorting the dollar on, for example, let's say even you're shorting dollar yen, and then you see opportunity to buy Kiwi dollar. Well, it's the same because buying Kiwi dollar means shorting dollar, and shorting dollar yen means shorting dollar. So you are overexposing yourself to that currency pair. So that's correlations and risk exposure. How you can manage that risk exposure as well is by hedging. All right. So basically, hedging is when you've got a risk and you basically buy another asset to minimize that risk. Okay. So let's say I own Air France, okay, which is a airline company, and so my profits depend on clients, obviously, but also I'm really dependent on the oil price. Okay, if the price of oil suddenly climbs up, well, my business is sort of fucked because it will cost me a lot more in order to fly my planes. Okay, so I will lose money if the price of oil goes up. Okay, so how can I counteract that effect? Okay, and that risk I'm exposed to in order not to be exposed to too much risk? What I'll do is basically go to trade and basically buy oil in order to hedge. Okay, and that's done a lot by companies. Okay, nearly all companies do that in order to limit their risks. So in order to hedge, okay, so I will buy oil. So if the price of oil goes up, well, my company will lose money because it costs more to fly. However, because I bought oil, I made money on that. Okay, so the profit made on oil counterbalances the loss I made in my company. Okay, so it's the same in trading. All right, so you could basically, let's say, I could short Kiwi CAD and buy Kiwi dollar. Okay, what will happen then is that one of the two will probably hit stop loss. Okay, let's face it, it will probably hit stop loss because they should move approximately the same way. But with risk to reward ratios, let's say, so I shorted Kiwi CAD and that reaches my target, so I make 3%. Let's say I've risked one. And my Kiwi dollar, which was hedging this position, so limiting my risk, I've lost it, all right, because it went sort of the same way. You see, today lost 0.50% and there 0.7%, so both are going down. Well, I will probably lose my Kiwi dollar trade and lose 1%, all right? So overall, I'm 2% up. So that's all about hedging, and you can manage your risk, okay? Even if you've got, let's say, well, that's quite long term, so it wouldn't affect. But if I've got a short term trade on dollar, for example, buying dollar, I could short dollar on another currency pair before news. Okay, so if the news goes my way of my initial trade, great, I lose my other trade, but no problem, I've made back that money on my previous trade. And if I get fucked on my initial trade, well, the trade I took to hedge basically puts back my profits and puts me sort to break even. Okay, so it's quite an important thing to understand hedging as well, and will even help you in business. Okay, if you've got your own business, you need to understand hedging, and yeah, so that's all about risk exposure and hedging.